Hello, welcome at 10 Commandments for Stock Investment YouTube channel. S&P 500 Growth ETF, Beneficiary of a Quiet Market. June 11, 2021 by DM Martin's Research. SPYG, a growth stock ETF, may be a smart bet at this moment of low volatility in the markets. Established growth stocks tend to produce higher absolute returns over longer periods, with reduced volatility offering added incentive to invest now. There are at least a couple of important risks to consider: high valuations and the coiled spring effect of decreased interest rates. Recently, I explained why a boring market, like the current one, can be great for long-term investors. Steady gains, i.e. beta, can be captured without the jitters caused by heavily caffeinated and trigger-happy traders. Today, I take the discussion one step further, and talk about which stocks might benefit most from this environment. I continue to believe that the cyclical trade may not have completely run its course. However, in the face of reduced volatility and lack of potentially negative catalysts in the near term, I believe that the case for growth investing gains strength. A heated debate can be had about whether the growth factor will reassume its outperformer position during a period of quick economic recovery. I tend to believe that it will, eventually, given the superior business fundamentals. For example, top-line growth opportunities and margin expansion driven by lower capitalization needs and gains of scale. The exact timing of this hypothetical market rotation back towards growth, however, is still unclear to me. Growth investing has the added benefit of possibly offering better protection against a deterioration in macroeconomic fundamentals, as it did during most of 2020. To be clear, I believe that this year's recovery will stick. But in case the reopening of the global economies hit a speed bump or two along the way, growth stocks are likely to fare better. The SPDR S&P 500 Growth ETF, SPYG, a fund of nearly 300 growth stocks and a heavy big tech bias, provides plenty of exposure to mega-cap names that will likely be winners in the long run: Apple, Microsoft, Amazon, among others. The ETF looks a lot like the S&P 500 on steroids, in the sense that the top 5 holdings in SPYG represent roughly twice as large an allocation as SPY's top 5. SPYG might be particularly more appealing to those who believe that underperforming FAMG stocks might be overdue for a rebound. The ETF allocates about 40% to the group, 4 to 5 percentage points more than peer Vanguard Growth, VUG, ever since SPDR's growth fund stopped filtering Apple out as a value stock. God is good, all the time. All the time, God is good.